That was it.
Yeah, that was it, right? Yeah. So that's looking at the composition, the mix, or the balance of the board of directors. A board of directors collectively and individual directors should act with integrity and bring independence of thought. So the reason why we want balance, and the reason why I'm concerned on the composition is we want independence of thought. The board, therefore, should not be dominated by a powerful chief executive or a chairman. The board should not be dominated by a powerful chief executive or a chairman. That's why in one of the, I think it was customer focused, one of my worries was that we are going through the pre-scene. I was worried that there was one guy, I think the elderly, forgotten his name. I was worried that he might have a lot more influence than all the other members of the company. So the board should not be dominated by, always remember that the board should not be dominated by a powerful chief executive and or a chairman. We need balance. We need balance. Even today, there are conversations around even the mix, male to female. We need more females in the boardroom. So it brings diversity into the boardroom. It is therefore important that the board should have a suitable balance and consist of individuals with a range of backgrounds and experience, right? Because it's overall, when you have independence of thought, you're able to make better decisions rather than, rather than just any kind of, rather than just regular decisions. Then you have, so you see where the corporate governance issues are. So please take notes. I'm saying it over again. Please take notes. Directors remuneration. That's also another area of another issue related to corporate governance. So to encourage their commitment to achieving objectives of the company should be given suitable incentives. So remuneration should be linked to performance, basically. Now you have risk management and internal. We cannot talk about corporate governance without talking about internal control. Remember, when we are talking about governance, we said governance is what monitoring and control, We said governance is monitoring and control. So we cannot talk about governance without talking about risk management and internal control. The director should ensure that the company operates within acceptable levels of risk. They're always operating within the designated risk threshold, and should ensure that there's a very, very thorough system of internal control within the organization. Very, very important. The last one is shareholders' rights. Shareholders' rights. The shareholders' rights vary between countries. These rights might be weak or might not be exercised fully. Their rights are expressed through some of their rights are the ability to dialogue, the ability to vote at general meetings. So if you are going through a case and you don't see that, you know that that's a problem. Shareholders should have their rights. Oh, there are more that I should have said. Okay, there are actually two here. Financial reporting. Sorry, I think the slide. I don't know why I love that one. So you see financial reporting, narrative reporting, and auditing. So that's also another issue. We talked about this actually, where the board must be accountable to shareholders. Then, of course, disclosure as well. So you have 1, 2, 3, 4, 5, 6, 7. So 7 issues when it comes to corporate governance. I would say don't go into the exams without knowing them. Don't go into the exams without knowing them. Okay. Now, you've talked about this over and over. Repetition is the best way of learning. This thing must stick. So we know who a shareholder is. We know who a director is. So I wouldn't want to bore you a lot. But I want us to look at other stakeholders. First of all, let's look at internal stakeholders or other internal stakeholders. Sorry. Other internal stakeholders. Now, the other internal stakeholders that I think we've talked about this before, but we are going through again. Now we have employees, right? Employees can be an important internal stakeholder group. Employees can be an important internal stakeholder group. It's very, very important. Very, very important. It might be possible to divide employees into subgroups, each with a different set of interests and expectations. So you see, if you remember in one of our classes, I asked, what is the interest of you as an employee? Some were telling me that they want the money. Some too, they said they want learning and development. Some too, people said different things. So here it's saying that it's possible to divide employees into subgroups. That's why it's always necessary to understand your employees and know what drives them. It's not everybody that is driven by money. So some people, they want to learn, the sharks. For the sharks, they want to learn. It might be appropriate to separate senior management and other employees into 2 separate stakeholder groups. You can also separate in that way. And because senior management might have a bigger interest in the profits and share price of the company, because they belong to a share incentive scheme or share option scheme, or because they receive annual bonus payments. So you can also segregate employees based on that. Just to track back a little bit, what is a share option scheme? We've talked about this before. What is a share option scheme? Anyone has an idea?
Okay, a share option scheme is one it's usually given to employees where they are given the option to take on shares or to vest or to take on shares or not. Okay. That's the share option scheme.
Fantastic. Share option. It's just the English. The option to pick up shares of a company. That's all it is. So please keep that in mind. Some employees might be able to demand large rewards from the company or might exercise strong influence because of their value to the company. For example, right, in the UK, some individual investment bankers have a strong influence within their bank because of the specialist skill they possess. So, and the income they are able to earn for the bank. Let me repeat that again because that's a good example. So, for example, in the UK, some individual investment bankers have a strong influence within their bank because of the specialist skills they possess and the income they are able to earn for the bank. So if you look at people like traders, traders bring a lot of income to the bank, and so they carry a lot of influence, when it comes to compensation and when it comes to expectations with regard to salaries. So that's something to keep in mind. Now, external stakeholders. We know them: lenders, suppliers, regulators, government, customers. Now, to avoid a situation where, I think we've talked about this before, have we? If we have, have we talked about this before? So that we move to agency theory. Okay, let me just go through since it's here. Okay, so lenders, if you're a lender to a company, what would be your interest? If you're a lender to a company, what would be your interest? If you've given somebody money, you expect them to pay. That's the lender. You expect them to pay. That would be their expectation. Even though lenders are not involved in the management of the company, they are interested in the financial performance. Because if they don't perform well, they'll not be able to pay them. They also have suppliers, right? Suppliers as well, if they are giving their staff on credit, they also want to make sure that you can pay. Regulators as well. Regulators can have an impact on governance in certain ways. Like, for example, if you look at NCA, National Communications Authority, I think they have quite an influence in terms of the governance of telecommunication companies in Ghana. Government also has a stake in companies because they're a source of tax revenue. Government gets their taxes from them. Customers as well. The company relies, on customers to basically promote their products, through word of mouth. Basically, the company is looking to give value to customers, and that would in turn if customers like it, to build a reputation of the company and all that. Now let's talk about agency theory. Agency theory, very, very important concept in corporate governance. We cannot talk about corporate governance without talking about the agency theory. The agency theory. Okay, so the agency theory is simply, first of all, let's define who an agent is. Let's talk about who an agent is. Who is an agent? An agent is simply someone who acts on behalf of another, and the other person is the principal. For example, a selling agent acts on behalf of a principal, a manufacturer of goods, to sell goods on a manufacturer's behalf. Similarly, a stockbroker is an agent who acts on behalf of a client to buy or sell shares on the client's behalf. The agent acts in the name of the principal and commits the principal to agreements and transactions. So these are examples, right? Someone who acts on behalf of another. So a stockbroker like this, if you want to buy stock, you go through a broker. The broker is your agent. He will act on your behalf to help you buy or sell stocks or shares. It's like a middleman to you. He's an agent. It's the same way in football as well. If you want to buy a player, you go through their agent. Yeah. It's not, if it's for a cowboy, it's different. But on a professional level, you go through the agents. The agent acts on behalf of the player. If you need a player, you talk to the agent and every agreement is established. In company law, the directors act as agents of the company. The board of directors as a whole and individual directors have the authority to bind the company to contractual agreements with other parties. Now, since most of the powers to act on behalf of the company are given to the board of directors, the directors have extensive powers in deciding what the company should do and what its objective should be, etc. So the directors are the agents. The owners are the principal. The principal is someone who contracts the agent to do something for them on their behalf. So they are expected to act in the best interest of the principal. That's why it's called a fiduciary relationship. A fiduciary relationship. If you want the legal term, it's called a fiduciary relationship. It simply means a relationship that involves trust, right? Where one is expected to act in the interest of another. It's very, very important. So you see, we have fiduciary duty of directors, exactly what we are talking about. As agents of the company, directors have a fiduciary duty to the company. Sorry. Sorry. Agents of the company, directors have a fiduciary duty to the company. A fiduciary duty is a duty of trust. Like we said, right? A relationship that involves trust. Trust. A director, therefore, is expected to act in good faith. So you don't put your interests before the interest of the company. So that's the same way in politics as well. That's the way it's expected to be. But unfortunately, it is not. You must not put your personal interests before the interest of the country. But unfortunately, it is not. Unfortunately, it is not. Okay. Now let's talk about agency law and the direct and challenging the actions of directors. Agency law and challenging the actions of directors. Challenging the actions of directors. What do we mean by challenging the actions of directors? Okay. When it comes to practical terms, right? It comes to very, very practical terms. It is very difficult for owners. Just think about it. How owners challenge the action of directors. What do you think they can do? If I'm an owner, I have a share in, let's say, EcoBank. How do you think I can challenge directors? Okay, let's find out. In practical terms, it is very difficult for shareholders to use the law to challenge the decisions and actions of the company's directors. If shareholders believe that directors are not acting in the best interest of the company, like we've already indicated, the ability to do something about it is restricted. It is quite difficult, basically. It is quite difficult. If I own shares at Microsoft and I don't like the way the company is being run, how much can I do? You know, I can't go and sack the director there or the directors there. The best thing is that if I don't like to be, I have to sell my shares. But you can't really challenge their decisions. The shareholders can vote to remove any director, so you can use your voting rights to do it. But the restriction here is that to do this, you need majority votes. So what I was trying to say is that on a personal level, I can't do much. Unless it becomes an aggregate problem where a bunch of shareholders think that, you know what, these directors, they just suck. They are not doing well, so we need to take them out. And then if it's a personal thing, it becomes difficult to challenge. It becomes very difficult to challenge. In a court of law, shareholders would have to demonstrate that the directors were acting against the interest of the company or against the clear interest of particular shareholders in order to persuade the courts. So it's quite difficult. If you go and stand in court too, you must demonstrate. Now, when a lawyer says demonstrate, it means demonstrate. So you must demonstrate that the directors were actually acting against your interest. You know, and that requires some effort. You know, that requires some effort. Yeah. So I think when you look at the whole PAC, Public Accounts Committee thing, right, and you check, you know what they were. One of the things is they were checking for is a demonstration. They were checking to see if these management committee members or whoever they were actually acting in the interests of the country or of the agency which they were serving. Okay, any questions on that? Any questions? Hey, today no questions. Okay, it seems there are no questions, so I'll gladly continue. Whereas agency laws deals with the legal relationship between a company and its directors, the theory of agency deals with the relationship between a company's owners and its directors. I hope this makes sense. So agency law deals with the legal relationship. Remember, we said that the company is a legal entity, it's a legal person, it's a legal personality. So agency law deals with the legal relationship between the company, right? The company is a person. Never forget that. It doesn't sound like it, but in law it is. The company is a person, so it's a legal relationship between the company and its directors. The theory of agency deals with the relationship between owners and managers, which you've already know. Agency theory is based on the idea that when a company is first established, its owners are also usually its managers, which is quite true, right? When you are starting a company, you know, you don't have that complex structure in place where you separate ownership and control. The owners will be the managers. They will be, and I think in Customer Focus Limited, the owners were the managers. As a company grows, you know, so one of the things in that case, you know, is to whether it would make sense for them to get clean, is it clean eyes or what? New people who might have a fresher experience to actually manage the company, you know, because the owners were the same as the manager. So if you get, it's like a football team where the coach, one of the players is the coach. you know, it's a good idea. Sometimes you need someone who is not in the game, someone who is looking from afar to be able to direct everyone. And so it's like a similar situation here. As a company grows, the owners appoint managers to run the company. The owners expect managers to run the company in the best interest of the. So that's what we've talked about over and over again. Now let's talk about the agency relationship. Now this is a repetition of concepts, but it's necessary. It's necessary. It's necessary. Okay. The agency theory was developed by two individuals called Jensen and Mecklin. And they suggested a theory of how the governance of a company is based on the conflict of interest. So you see, when we say conflict of interests, it's very simple. It means we have diverging interests and they are clashing. Between the company's owners, its managers, and major providers of debt finance. Each of these groups have their different interests and objectives. So for the shareholders, they want to increase their income and wealth, which we all know. The managers, you know, they want their compensation. They are more into their bonuses. They are more into their remuneration packages. Providers of debt finance, they are more into, you know, receiving the money they've lent back. It's very, very simple. Any questions? Today there's no question. Is it understandable? If it's understandable, please type yes, so that I'm sure everything is going okay. Because the way no one is asking me. Okay. Mm-hmm. And also, let me ask, have you guys been looking at, have you guys been looking into the past questions? Please do. When I gave an assignment, only 2 people submitted. Don't wait for pre-scene. The pre-scene will come, and then you see that, I haven't learned anything. The agency relationship is defined as a form of contract between companies' owners and its managers. You know, we've talked about this over and over and over and over again. We've talked about this over and over and over again. The owners expect the agents to act in the best interests of the owners. Ideally, the contracts between the owners and the managers should ensure that the managers always act in the best interest of the owners, blah, blah, blah. Now let's talk about agency conflicts. So agency conflicts are simply the differences in interests of companies, owners, and managers. And how do they show, or how do they manifest? Number 1. So these are symptoms that you look out for in your pre-scene material, right? Whether there's an agency conflict or in your case. Number 1, moral hazard. A manager has an interest in receiving benefits from his or her position as a manager. This includes all the benefits that come from status such as company car, private chauffeur, use of a company airplane, lunches, attendance at sponsored sporting events, and so on. So a manager has an interest in receiving benefit from his or her position as a manager. So where you are using your position to derive benefits. That's what we call a moral hazard. It is not moral to use your position to derive benefits. Okay, number 2, effort level. Managers may work less hard than they would if they were owners of the company, right? And this is one of the biggest problems in Ghana. If it's not our company, we work less hard. So managers may work less hard than they would if they were owners of the company. So that's also a conflict, because there you as an employee or as a manager are looking for interest. So you're not putting as much effort. And this lack of effort could lead to lower profits and lower share price. So you see the problems that are arising. Number 3, earnings retention. The remuneration of directors and senior managers is often related to the size of the company rather than its profits. This gives managers an incentive to grow the company and increase its sales turnover and assets rather than to increase the returns of company shareholders. Management are more likely to want to reinvest profits in order to make the company bigger rather than pay out profits as dividends. When this happens, companies might invest in capital investment projects where the expected profitability is quite small and the net present value might be negative. So basically what we are saying here is that there's a conflict of interest with regard to earnings retention, right? So since shareholders are looking more at long-term wealth, shareholder maximization, they would be more willing to plow back, right, profits back into the business, which pushes, which in turn will help the company to yield more profits, push their share price, and push shareholder wealth. Now, managers' interests are quite different, because the manager, he sees that one, it's not his company, and they might leave soon. So earnings retention might not necessarily, they would rather receive dividends or they would rather receive bonuses, rather than plowing back into the company. So this is where some of the issues arise. Another thing is risk aversion. Risk aversion. Executive directors and senior managers usually earn most of their income from the company they work for. They are therefore interested in the stability of the company because this will protect their job and their future income. So what does it mean for a manager? A manager or the management would be a lot more risk averse. They wouldn't want to take any risk that would jeopardize their job security. So they might not invest into high risk projects. And the higher the risk, the higher the profits or the return, right? So for management, there might be some form of risk aversion, and that is it's a conflict. It's a conflict. Please, these points, don't go into the exam without knowing. Yeah. Time horizon. Shareholders are concerned about the long-term financial prospects of their company because the value of their shares depend on expectations for long-term future. In contrast, managers might only be interested in the short term. So there's a conflict in terms of time horizon. Managers are interested in short term. Shareholders are interested in the long term. So managers are more focused on, or management is more focused on what do you call it? Bonuses and all that now, and how shareholders are looking at the long term. Now, agency costs. Agency costs. What are agency costs? These are the cost of having an agent to make decisions on behalf of a principal. The cost of having an agent. So to make someone act on your behalf, you have to incur some costs. You have to pay the person. Applying this to corporate governance, agency costs are the costs that shareholders incur by having managers to run the company instead of running the company themselves. So basically you have to compensate agents. You have to compensate agents. You can't do everything by yourself. No, it doesn't work that way. You can't do every single thing by yourself. You can't do every single thing by yourself. Agency costs do not exist when the owners and the managers are the same individuals, right? If they are the same individuals, where do the agency costs? Except I don't think anyone except maybe you want to be greedy and pay yourself a lot, but generally that doesn't exist. Agency costs start to arise as soon as shareholders are not directors of the company. One thing we need to know is that agency costs are very high in very large companies. When you go to large companies, if you look at the salary of directors, who can guess the salary of Satya Nadella, the CEO of Microsoft? Just type, what do you think? How much do you think Satya Nadella, CEO of Microsoft, earns? Type it in the chat. In dollars, not Ghana cedis, please. Just a guess, please. I'm waiting on. Just a guess, a guess. Hey, a guess, okay. I'm waiting. I'm waiting, please. Only one person has voted. What is his total compensation? If you add everything. Okay. Okay, some people have voted. Hey. Someone said $50,000 per month. Okay, so his salary as at 2020 was $2.5 million. That's only his salary, right? But he had a cash bonus of $11 million. And he had stock awards of $30 million. So overall, he had about $44 million. In a year.